Hey, good morning, good afternoon, or good evening to you, wherever you are in the world. Thank you very much for joining our live discussion tonight. I'm your host, Liam Higgins. I'm the crypto consultant here at cryptotaxaudit.com, and I'm very happy to be joined with the founder of cryptotaxaudit.com, Mr. Clinton Donnelly. Clinton, how are you doing tonight?
I'm doing great, Liam. Super glad to be here.
Wow, what a roller coaster ride 2021 was. We had some notable events, from the Coinbase IPO to El Salvador making Bitcoin legal tender, to the massive explosion, I guess, in the DeFi space. And that's going to be our main focus tonight, is DeFi, but specifically how DeFi traders may run into some difficulties when filing their taxes, and more importantly, how they can protect themselves from the IRS. So Clinton and myself are going to speak for about 25 to 30 minutes. Some members in the audience have already submitted their questions, and Clinton and myself will run through them. So do feel free to also submit questions as the discussion goes on, and we'll try and get to them. Maybe not them all, but we will try our best to get to them. I do have to say that this conversation tonight is not financial advice. Everybody's tax situation is different, so please do seek your own professional advice for your own specific tax situation. So with that being said, let's dive into it. Are you ready, Clinton?
I'm ready. Let's go at it.
You've got your coffee in hand?
My assistant is going to fetch it for me. I'm frozen.
Oh, perfect. So maybe let's start off the discussion. We may have some members who are not familiar with you or your company. So you might give a little introduction to yourself and what cryptotaxaudit.com provides its members.
So we started doing cryptocurrency tax returns in 2018. Some of my largest clients I had back then. And ever since then, we exploded and became specialists. We're probably the largest firm in doing cryptocurrency tax returns, private firm. We prepare tax returns for crypto traders, and we prepare them with a special methodology. We call it the bulletproof methodology. We add extra things you wish were there if you knew in advance you're going to get audited. And in fact, everything we do is about addressing the issue of an audit. How do we protect people? For crypto traders, it's not so much if you'll get audited, but when. So we also defend people in audits. We have defended 25 people in audits before the IRS on their crypto reporting. And we also offer unique insurance services to support that. We also give people some free training. Well, it's not free, but it's a $75 training course on how to prepare your own cryptocurrency tax return.
Great introduction. Thanks for that, Clinton. And I guess before we dive into the complex DeFi that we're going to explore tonight, let's maybe start with some of the basics, because I know a lot of people got into cryptocurrency in 2021. Some of them, getting familiar with the terms, and some may have never filed a crypto tax return before. So I mean, even the word cryptocurrency in itself can be a little bit confusing, because it's not a currency, is it? So I guess my first question to you, Clinton, would be, how is cryptocurrency characterized, and how does a person know if they have experienced a taxable event?
Well, that'll be good. We're going to talk about some advanced crypto tax treatments here, but let's hit some basics, because like you said, a lot of people, this is their first year getting into it. I've talked to a lot of clients. I talk to dozens of clients each week, and a lot of them are asking basic questions. So cryptocurrency is considered property by the IRS. And as property, it's not currency. It's a subtle difference, but even though the word is cryptocurrency, it's not really currency as far as taxes are concerned. With property, when you sell property or exchange it for something else, you experience a gain or loss. And that is called a capital gain, or capital loss, as the case may be. And that gain or profit from the transaction is what you're taxed on. So it does not matter what you exchanged the currency for, another cryptocurrency, a stable coin, fiat, or your Lamborghini. It doesn't matter. It only matters the fact that you disposed of it. So everything we do on a tax return is based on the fair market value in US dollars on the date the transaction happens. So that's how we compare it. Now, if you use a service like Coinbase, there's prices that are established for all that. So you use online services, and we're going to talk about a bunch of them here today that help calculate your gain. And you absolutely need to use these services because doing it by hand, your brain will explode after you do about 10 transactions. So by hand. So you have to use these services, and they will tally up the gain and loss. On your tax return, you report gain and loss on Form 8949, which is basically a paper version of a spreadsheet, and it rolls up basically the net profit from all your trading. And that goes on to Schedule D. From Schedule D, it goes up onto your main tax return. It becomes a part of your adjusted gross income from which eventually your taxes are calculated. The other type of income that typically happens with cryptocurrency would be rewards. So if rewards can happen in a lot of different ways. You could have, staking rewards. You might be lending and be receiving some sort of reward or interest type of payment. You might get an airdrop, but these are all different types of coins that you get from different sources. So those are typically treated as, and you can listen real carefully to how I say this. The typical treatment is it's taxed at its fair market value in US dollars on the date it's constructively received. A lot of people call up and say, I didn't really receive it because I didn't pay the fees to bring that off that blockchain onto my Ethereum token, wallet. When is it dated? It's dated when it's readily available to you. The law says as long as there's not substantial hindrance to getting it, then it's considered received when it's made available to you. That's called constructive receipt under regulation section 1.451-2. So you caught that, didn't you? The last thing would be that if you get paid in cryptocurrency, again, it's the fair market value in US dollars on the date you got paid is what you're reporting. And if you bought something with cryptocurrencies, a thing, then that's effectively a sale of a cryptocurrency. And it's the fair market value in US dollars on the date you bought the thing is what you're going to report as the sale price for gain purposes on your cryptocurrency. That's in a nutshell cryptocurrency taxation.
Fantastic. What a run through. Just for our audience out there, Clinton, you gave a really good detailed response there. This is being recorded, and so anyone who wants to look back over this video and go through the points, you can look at it as many times as you like. Great stuff, Clinton. I know a lot of focus has been on Gary Gensler and the SEC, and they've come under immense pressure for not providing enough guidance and clarity regarding cryptocurrency. But what guidance or clarity has the IRS given regarding cryptocurrency?
Well, the IRS wrestles with the same challenge the SEC does, which is that the lawmaking body in the United States, which is Congress, has not really issued anything about cryptocurrency, whether for regulatory purposes or for taxation purposes. And as a result, the agencies have to use the existing laws and regulations and somehow shoehorn cryptocurrency into its regulatory framework. For the IRS, this is difficult because cryptocurrency, first of all, it's property. They're saying it's property, but as property, it's really not like a stock. Stocks represent ownership in a company, and cryptocurrency is not an ownership of a company. Then the other aspect would be, is it a bond? Well, it's not a bond. That's a different type of financial instrument, and so it creates some real challenges to confidently apply the law. And one of the things I studied when I was getting my law degree was how to argue a case from 2 points of view. And in my opinion, whenever we take someone into defense on a cryptocurrency before the IRS audit, you eventually have to end up to a court, because that's the only time you get to talk to somebody who's objective, the judge, who can actually arbitrate some of the stuff. What the IRS has done is they've provided some guidance. Now, let's put that in perspective. Guidance is not law, okay? It's their opinion. right? And they're entitled to their opinion, and you're entitled to disagree with it, okay? We have a hierarchy of authorities. Law is made by Congress, and law must be kept. And we have courts that help interpret and apply that to unique situations. Underneath the law, we have regulations. The IRS makes regulations to tease out the complexities or the implementation aspects of the law. Now, when they do regulations, they have to have public notice, there's public comment. It's a very lengthy and formal process. Underneath regulations, they have procedures and rulings. They have things called notices and press releases, and just commentary things, FAQs, all of which have a decreasing level of importance and significance. And some of them are not even binding. It's just an opinion. Now, the first piece of guidance that came from the IRS was what's called a notice. Now, a notice is just a general application of principles. It also is a foreshadowing of some future procedure that might get announced. No future procedure got announced. So all it was a notice, 2014-21, which basically stated that cryptocurrencies are virtual, is a type of property. The type of property is called a virtual currency. And inside a virtual currency, it's called a convertible currency. And then from there, it went on to have an FAQ. And this FAQ, again, FAQs are totally non-binding. In the FAQ, it makes assertion that airdrops were taxable, mining was taxable when the mines were, a whole set of opinions, which fall into the category of, they're barely binding in terms of the hierarchy of laws. The next edict that came, and that was in 2014. 5 years later, the IRS came out with something else, a revenue ruling, 2019-24, which basically said that hard forks, like airdrops of currencies that result from a hard fork were taxable as income at the fair market value when they're received. Well, they came out with this and they were widely ridiculed because it evidenced that they didn't understand how cryptocurrencies operated. And I got this little tidbit for you. I learned this, that people that work in Congress, work for the Treasury Department, they cannot own cryptocurrency. IRS officials cannot own cryptocurrency because they're regulating it at the same time. They can't own it. And as you know, Liam, and because you and I talk, all the time, you really have to have your hands in it and get dirty to really understand cryptocurrency. And this is a handicap that the laws prohibit a lot of our officials from even understanding cryptocurrency. So, and we're suffering from that. The other guidance that they had was a non-binding FAQ 2019. And then this past May in 2021, they came out with an IRS counsel's private letter. This is non-binding, but it expresses the opinion of the council that like-kind exchange of crypto for crypto before 2018 was not considered a like-kind exchange, that it was each of them were taxable. This happened to be an extremely flawed private letter ruling. It was flawed in the sense that they made a claim that Litecoin was not taxable, was not able to be purchased in fiat in 2017. I have witnesses that prove that they could do it. And then they also claimed that Bitcoin was different than Ethereum because Ethereum had smart contracts and Bitcoin didn't. And I went in, I've been able to prove to them that that's wrong. Bitcoin has smart contract ability. It's not as good as Ethereum, which is why everyone uses Ethereum. But it's there. It's always been there. And so we really have shredded it. And the whole logic of that paper was just pathetic and as flimsy at best, which has been characterized most of the guidance that's come from the IRS. We're now at a point in time where IRS has audited some people, and these audit cases are starting to go to court. And the IRS is starting to confront some of the problems that they have with these rulings. And the IRS is very intent on not losing audits. So we're going to start to see a lot more concession and wiggle room in these enforcement of how these choices of how people tax crypto. So, you have choices where, the guidance is non-binding. People think this is guidance. Just because the IRS has opinion doesn't mean it's right. So that's my 2 cents on, guidance issues from the IRS.
Excellent, Clinton. I wouldn't like to be the IRS agent on the other line with you.
I had one call while we were talking. It went to voicemail.
But, like you said, it's not just buying and selling Bitcoin anymore. The industry is developing so quickly, which I guess leads me on to my next question. With cryptocurrency being a new asset class and developing so rapidly. I mean, we've got farming, liquidity pools, staking. Let's focus on staking because it's such a popular topic. How does the IRS tax this, and how are they determining what's a capital gain and what's income, for example?
Well, this is a great question. For example, until Congress gives us more guidance, the IRS is going to wrestle with it. Let's tease this out. Let's talk about staking rewards first. Are staking rewards interest? Is it considered a form of interest income? Well, it turns out it's not, because interest income, as defined in the tax code, represents income that's derived from bank deposits and other deposits and uses of currency. Remember, cryptocurrencies are not currency, therefore interest doesn't apply. Now, I'm not saying that the concept of interest isn't there, but under the tax law, it doesn't fit. Well, is staking rewards, are they dividends? Well, when we get into the definition of a dividend, and that's what we do with the law, is we always we tease out what's meant by this. And the challenge here is that a dividend is a distribution of profit to the owners of a corporation. They might be stockholders or partners, but it's from the owners. Well, that's not what cryptocurrency is. When I get a staking reward, it's not a distribution to the owners of a company. All right, it's the owner of a share of a coin, but not an owner of a company. And so it breaks down applying that rule to cryptocurrency. Well, how do I treat crypto staking rewards? Well, in the regulations that I've cited earlier, the IRS wants people to treat staking rewards as fair market value taxed upon receipt. And they quote the Glenshaw Glass court case, which it goes back into the 40s. And it is an issue where the judge makes this rather meaning-laden statement that the IRS loves to quote because it sounds good for their purposes. The judge said, any ascension to wealth clearly realized is income. So ascension to wealth means, the fact that I have any sort of personal gain, they say that's income, you get taxed. That's how they interpret that judge's ruling. But mind you, they're hanging on a judge's ruling. The difficulty is that when we get to staking rewards, is that really appropriate? For example, another way of looking at it, and there's actually a court case in process right now at the district court, popularly it's called the Tezos staking case, but it kind of goes this way. I have an asset. This asset is a chicken. I bought the chicken because chickens lay eggs. My chicken lays an egg. All of a sudden I have a new asset. Am I taxed by the government when my chicken lays an egg? No, I'm not. Am I the egg? When am I taxed on this production of egg? It's when I'm selling it to an end user or to someone else. Another example would be the idea of a baker. A baker bakes a loaf of bread. Does he pay tax when he takes it out of the oven? No, he's taxed when he sells it. So this argument flows from the notion of production. A company that makes sneakers isn't taxed until the sneaker is sold. Right, that's when the income tax kicks in. So this kind of challenges the whole notion of Glenshaw Glass. And the point is where Glenshaw Glass, the judge says, clearly realized. And that's the problem with the IRS's position. And so as a result, if you have a situation with staking rewards, you could tax it the way the IRS wants you to, which is upon receipt. And a lot of people are upset about this, especially the XRP community, because they're getting a lot of airdrops of special coins like songbird, flake. Do they have to sell these in order to pay taxes on coins they've never had any gain from, so to speak? It rubs them the wrong way, and rightfully so. The alternative approach, which is the tax upon sale, would be that when I eventually sell those coins and I make some money, then that's when I pay my tax, or that's why I have to take the tax out of that money, which I think is aesthetically more understandable. Even Congress has written to the IRS commissioner in the Treasury Department demanding that, when I say Congress, I'm talking about the Ways and Means Committee, is saying don't stifle innovation by excessively taxation of staking rewards. So this is kind of interesting. So what we have here is a contrast of views. The IRS has this kind of aggressive position, and there's a lot of other people saying that position doesn't hold water. I have it on good authority that the IRS is caving on the Tezos case, but it's going to be forced to court in order to create a case precedence by a judge deciding that staking would not be taxed on receipt. So I think that we have a lot of hope that that's going to be passing. So that's just one aspect of it, and it gets more and more complicated. So, but we have choices. You have choices when you prepare your taxes. Ultimately, now think about this. Ultimately, whichever way I do, taxed upon receipt and then taxed again when I sell it, or simply taxing it when I finally sell it for pure gain, either way, I eventually am paying taxes on all of it. It's really just a matter of when. And of course, sometimes when will influence what the tax rate is at the same time. So that's a great question.
Wow, that's a great answer. And that is a space to watch, that Tezos case. So I think, let's see how that unfolds, because that will make a significant difference for crypto traders and especially people staking. Thank you, Clinton. We've had a lot of clients come to us, and I've also seen this on Twitter as well. And it seems that everybody is complaining about the crypto tax services that are out there. I mean, in our experience, we have used several of these different softwares. I can think of about 6 off the top of my head. And we have run the same DeFi addresses through these softwares, and the results have been absolutely staggering. I mean, we're not talking about 1,000 or 5,000 in the difference. In some cases, we were talking $1 million in the difference. And people have been saying, how inaccurate these are. Why do you think that is, Clinton?
Well, I think my assistant's going to get some slides up for us here in a second. But one of the reasons, I want to skip that to client 1. One of the reasons, everyone I talk to wants to pay taxes. They want to pay their fair share of taxes. And especially investors that have been using various services in prior years, where all their trading happened on centralized exchanges. There's about 24 services that do this, what we call crypto gain calculation. They like to call themselves crypto tax software, but that's a far reach, because they don't calculate tax. They only calculate income. And they're not tax software. That's what TurboTax is. So we've looked at these services, and they all worked well. We all depend on them to determine how much income we report and pay taxes on. Now people going into the DeFi space, and people call me up and go like, there's no way I could be owing this much. There's just no way. And they were staggered. And like you said, we have our own team of accountants and analysts inside. We use almost all the tools that are out there to different degrees. But we also have a forensic accountant that went through and did his own, tied out all the calculations on, pulled Etherscan, the fair market value of every transaction, tax implication, every transaction. And we've tied them out, and we have a pretty high confidence what the taxable income is. But that's a very laborious process. It takes man-months. So we then said, well, how are people coming up with the right answer? So we would take like this here in client 1, he had 2 ETH addresses. This is data from 2020. So he ran maybe 2,000 transactions through DeFi. Predominantly, he was using Curve and Balancer and that sort of thing. And as you can see here, now we ran these same benchmarks on these companies on different dates. The most recent one we got the results all today here in the second column from the left. And you'll see the numbers range here from $3,000 to $1.2 million in gain. All right. Now, you might have picked one of these services and you have a predicament. The answer you're going to see is either way too low or it's way too high. Now, everybody wants to pay taxes, but we don't want to pay taxes on the fair amount of income that we made. And we used to trust these services, and now we're at a point where the answers are wildly inaccurate. And if you take a look at, some of these people are actively changing some things. So if we look at Coin Tracker, that's the third one down, we see right now they're coming up with 625,000. Back at the end of October, they're into a $187 loss. And before that, they were at 917,000. So you can see these guys are aggressively tweaking their applications. Now, let's talk about why are these answers so erratic? Well, partly it's because DeFi is exploding so quickly, it's difficult for these applications to respond. And secondly, most of these applications, they need to be completely rewritten. Most of them are using their Gen 1 product, which you used on what we call CFI, centralized exchange calculation, where, on an exchange, you record the buy and sell. Because with exchange trading, you basically buy it, I transfer it, and I sell it. And when I sell it, like on Coinbase, let's say I sell Bitcoin for Ethereum. Now, these are two different blockchains, right? So the price of Ethereum is not recorded on the Bitcoin blockchain and vice versa. So they're not there. So how do we know the prices? Well, the centralized exchange hold those two pieces of information together, and that's how we get it. But with DeFi, there is no centralized exchange providing that price reference. Instead, we have to pull it off the blockchain. And when we move into things that are beyond simple swapping on DeFi, then you get into staking, pooling, lending, yield farming, liquidity pools. We're talking to much more complicated things. The records are scattered, and there's many of them, and they're scattered on the blockchain. And these applications have to reconstruct what's going on. So bottom line is they all have to completely rewrite their application for a much more sophisticated data structure, and they need artificial intelligence to drive innovation. I have an article on our website, cryptotaxaudit.com/DeFi. There's an article which I talk about what we should expect from exchange services. I think they need to really up their game. In my opinion, on a scale of 1 to 10, most of these services are at around 5 in terms of meeting the needs of taxpayers at this point in time. Now, let's look at the next slide. This is just another example. This client heavily used an application called Yearn Finance, and he did also some liquidity pooling, and he had about 4,000 transactions. Here you can see the answers range from what's the lowest there? About 1.3 million up to 12 million. The reason we have a question mark at Bitcoin.tax, and it's good to talk about this. Bitcoin.tax had a problem with one coin, and as a result, their output was 23 billion. All right, that just gives you an idea of how one thing can really upset the ability of these applications to function. So we just put question marks in there because we didn't delete that coin off of anyone else. It's just they struggled with it, and we didn't want to disadvantage them. But like if you're a taxpayer, you have to make a decision. You have to say, do I believe the application is right? And people say, well, how do I calculate how much income to report when I'm an active DeFi trader? And again, by active, I mean not just simple swapping, but more advanced functions. And I would have to say that ultimately, any number you come from here, you're going to basically fact check it against your own feelings on how much income you made, your own inner approximation of how much gain you experienced from those investment activities. And to the extent that the numbers you see here differ from your inner expectation, you're going to feel that it's incorrect. So ultimately, at this point, you're going to have to go with reporting on your tax return a bulk number, which is based on your own estimate of how much gain and income you made. Now, so I basically put that in simpler words. You have to make it up, but it's based on your estimation. Nobody knows better than you, and these are the experts here, and they're clearly confused. So you have to make that as your own filing. Now, everything I do is how do we defend ourselves in an audit? So how do you defend an estimate in an audit? Now, estimates happen all the time in business returns, so don't be distressed by that. But how do we defend against that? When the IRS audits you, they will demand all your exchange transaction information and your DeFi addresses, and they'll run off and do their own calculation. Now, they don't have an application of their own. They're going to subcontract somebody. Right now, they're subcontracting the firm TaxBit and Zen Ledger to do gain analysis. Now, I've heard some people say that this means they're IRS certified. This would be a total misrepresentation. They're subcontractors. They bid and they won. Other people chose not to go after that work, but that's okay. Now, what happens 3 years from now? Let's say in this case, Zen Ledger was the company that IRS was subcontracting to calculate your gains for that year. Well, what we can do here is we can actually run what we call a DeFi tax benchmark. We can run, it's an offering we have. which you might consider if you're a larger DeFi investor, say over 100,000. We can run your numbers against all the systems and we'll document it. And what'll happen is two things are happening. One is you've exercised the requirements of the law to do due diligence and reasonable care in putting together your tax return, because we ran it against all the services. What more, Judge, could we possibly have done? Yes, we did the most. And my taxpayer did his best job reporting his income as he understood it. Now, 3 years from now, the IRS is auditing you, and let's say they use Zen Ledger. Right now, Zen Ledger is saying, I mean, you can see here these numbers. Today, Zen Ledger is doing 2.9 million on this guy. A couple of months ago, they said he had 9.3 million. So what will happen is we'll come back to the IRS and say, IRS, you're telling us that my taxpayer made, he had $4 million worth of income, but you said it was 3 million a couple of years ago, plus you said it was 9 million. So how can we presume, IRS, that the number you're giving us now is correct? What I'm doing from a legal point of view is we're placing the burden of proof on the IRS to prove that that the taxpayer is incorrect, because we will have 9 data points, possibly more, against the IRS, which has 1 data point, which we can disprove. So when you get to court, if the IRS can't prove it, then the taxpayer is free. So this is our strategy, is basically a multi-year defensive strategy. We think it's a phenomenal, powerful strategy for winning in an audit. And again, everything we do is about protecting people in an audit, because it's not a matter of if, it's when. And so this is a great tool to use. Now, does that mean everybody needs to buy this? No, it doesn't. I would say if you're a large trader in crypto, in DeFi particularly, it's something you might want to consider as to protect yourself. If you're a smaller trader, you only dabbled in it, but just go with your own estimate. You're not. It's a small number. It's only going to be a small error if you get audited on it. So that would be my advice on that. But let's look at the third client. This last client was very interesting. He did some Yearn finance, but he also liked to do a lot of ICOs. He bought a lot of brand new coins and speculated on them. So about 6,000 transactions. And as you can see here, the numbers are ranging from a $2.9 million loss to as high as $7 million in gain. So we're looking at a $10 million spread in the answers. I mean, that should be very disturbing. And if you look at, again, number 3, we know CoinTracker has been revising their web application. I mean, they went from a $337,000 gain down over 3 million. And if we look at token tax, there's very interesting token tax. You see, now they're at 7 million, but 3 months ago, they were at 29,000. I mean, they went from being the lowest to way out there and the highest. Look at Zen Ledger. They're down to 239 when they used to be at 5.5 million. So these aren't tweaks of their application. These are radical adjustments. And this is why everybody should be frustrated. Now, let me tell you, this is my perspective on this. There are different ways to tax things. And these companies, especially the ones that are based in the United States, are very afraid of lawsuits and litigation. If they gave you a gain calculation and the number came in low, and you reported it, got audited, and the IRS proved that you way underreported your cryptos, then they're afraid that you'll come and sue them, which is very common. When they're taxpayers, when they lose, always come back and sue their tax preparer firm, and if they're going to sue these firms. So these firms actually have a very high liability situation, and as a result, they try to take the position that they think the IRS would take on taxing things. Now, they like to call that conservative. They like to call that a conservative opinion, but it's not. It's conservative for them. It's outrageous for you. Okay, you should not be interested in conservative. You should be interested in what can I honestly report and defend. That's what you want to do. So, a couple of thoughts on that. Sorry if I went long. I think they're verbose,
No, that's. I remember the first time you showed me them results, Clinton, and it gives me goosebumps looking at them. That DeFi is so accessible now that you can log on to pretty much any app and get yourself into liquidity pools and yield farming, and before you know it, you're over your head. And just some of them results are staggering, but fantastic.
What really bothers me? What really bothers me is I understand that these companies are doing their best, and I know the heads of most of these companies, and some of these guys have like added, they're going into mass development mode. They're getting big funding to really rewrite their applications, and it's a work in progress. I understand that. What I feel is disingenuous by most of these firms is if you go on their website, they'll say, "We do DeFi. We're great at NFTs." They'll say this, but in fact, they're grossly inaccurate. All right. And what happens is they do certain things really well, but other things they haven't addressed it yet. And what bothers me is they have no disclaimers on their websites, nor when you run the applications, do they give you a little, hey, you did some things that might cause your output to be incorrect. They don't, there's none of that. And then if you, and clients have told me this, they've gone on to the chat function, hey, how come, these numbers are so wild? And then they paint it like it's your picture. Like, well, you need to go in and reclassify some transactions. You need to do that. But they're not owning up to the fact that that application just screws up at that point. That bothers me. There's no disclaimer. For example, on the coin tracker, which we've hit them a few times tonight, only out of coincidence, but every time we ran coin tracker results on all three of these clients, 10% of the transactions come out with errors. They have no proceeds. The proceed number says error, ERRO, comes out in the spreadsheet. It's error. And this problem is existed now for 6 months on these same accounts. These are three different customers, and 3 times, and we get the same problem. So all the numbers on CoinTracker are actually understated if they actually their application were actually working well. And CoinTracker just got $100 million of funding as a big news item just recently. But I wish they would be honest.
Yeah, well, I mean, Clinton, you've got a team of crypto analysts. I think 10 and counting who have pulled these tax services apart. So, for one person to go on and try one of these services and get errors, they might say, oh, okay, maybe I don't know what I'm doing, but you've got experts working on these services and you've just shown us the results. So it is staggering how wildly inaccurate they are. You mentioned that these providers are taking what you said, a conservative position. Are there other alternative tax treatments that these services don't allow or don't offer?
Yes, there are. And we had originally planned for this webinar to go for about an hour, but I realized I've been a bit verbose. I get passionate. So we'll extend this a little bit longer than just to put that out there. Yes, in terms of alternate tax treatments, I mean, we talked about staking rewards. Do you tax upon receipt or tax upon final sale? That's very big. That could completely wipe out someone's taxable liability for years until they sell those coins. They ultimately will still pay the same amount of tax to the IRS, although the tax rate might differ. Now, another one, this is a very important example, would be, I call it locking. And it happens in a lot of different forms. The first type of form would be simply a wrapped coin. If I have BTC and I wrap it onto the Ethereum blockchain, I have a wrapped BTC, a WBTC or a red BTC. Is that a taxable event? Now, remember, all these crypto gain services are all using their Gen 1 application. They love to see events where I exchange because they know how to tax that. That's what they do. And it's kind of like, to a man who has a hammer, everything's a nail. So when we get to this problem, they go, oh, you exchange this BTC for a WBTC. And then they will consider that some sort of gain event and generate tax, let's say at short-term higher rates. And then later, when you take the wrapped BTC and you burn it back to get your BTC back, they will treat that as another transaction. Again, short-term gains, higher tax rates. I don't think that's an accurate interpretation of the tax law. The regulations 1.1001-1 are very clear that when an exchange occurs, when you have materially changed something for something else. In this case, with my wrapped BTC, I expect to get my BTC back. All right. I've just wrapped it up in a manner that it sits on the blockchain. This is an administrative thing. How can I give an example? I go to a parking garage, and the valet is there. And let's say it's a hotel. I give the valet my keys to my car. He gives me a little slip of paper with some big number on it, and off goes my car. Was that a sale or exchange? Is that a taxable gain on my car? Because I traded it for this ticket, which is, how much did I pay for this ticket? I paid $0 for this ticket, other than a transactional fee when I gave the guy $1. So, but then when I bring it back and I burn it by giving it to the valet and he reproduces my car, was that another taxable event? No, that was my car. There's no taxable event on it. But yet, so these services will generate taxable events where I believe an accurate interpretation of law says there's no taxable event here. This is one reason why you see such very high numbers on the charts that we just saw. Another way locking occurs is when you do staking. So I stake it, staking can happen, proof of stake, proof of history, even proof of work. I have my coins and then or tokens, and I delegate to somebody else to verify or do something with. At some point in the future, I expect to get my coins back. All right, so that is not a taxable event when I put them into a staking pool, even though I might get, let's call it some sort of receipt token or not. It's still not a taxable event because I expect to get my coins back. So that's that one. Moving further, let's talk about another one. Rebasing. This is very intriguing. If nobody knows about rebasing, I think Ampleforth is a rebasing coin. There's some others. Rebasing, there's a smart contract which, in order to keep the price of a token within a certain range, will on a daily basis typically go into your wallet and change the number of tokens that you have in order to keep the price in that range. Now, a lot of these services don't know what to do with that. They'll treat that as a taxable event. When I get more tokens, so when the price goes down, they give me more tokens. They'll treat those as gains. When some disappear, they'll treat those as sales. And nothing of the same sort is happening, because what we're looking at in rebasing is an equivalent to a stock having a split. Okay, so if I have Apple stock, if I have 20 Apple stock that I bought for $2,000, let's say $20,000, and then Apple announces a stock split, say 21 for 20. Now what I have is 21 shares of stock. The price has changed, perhaps. I have 21 shares, but it's still, there's no gain in ownership. The cost basis is now distributed across 21 shares rather than 20. This is not a taxable gain event. In stocks, when stocks split, these are not taxable events. It changes quantities, which creates a complication, but that's not a taxable event. So that's how rebasing do. We can get into liquidity pooling. Same thing with liquidity pooling was the locking example. Yield farming is a little more complicated, but there are some alternative viewpoints that come to bear there. All of these things, these options and more favorable tax treatments are not being extended by any of the crypto gain services out there. And in my opinion, everybody should have the chance to pick and take their own choice on how to handle the taxation of their cryptos. Because right now, all these crypto services are taking as what they call conservative. I call it pro IRS position on all these taxes. I mean, you've heard of people are upset about the Biden's vax mandate. Some of these services have a tax mandate. So, so we need to protest against that. And I think we've shown you the methods and how you can do that here in this video already.
Another great explanation, Clinton. I should have known that this wasn't going to be a 25, 30-minute chat. I mean, the client, people on are in the audience today are really getting value for money at this free event.
Hey, I don't hold any punches.
Yeah. So moving on from that, then, how can an active DeFi trader report his or her gains?
Well, as I said before, you're ultimately going to have to estimate it. And you're going to estimate it as a one line item. You're not going to add for reporting your CFI gains, report those as you would all of them on an 8949 form, which goes onto your Schedule D. Rewards that you're going to declare should go on your Schedule 1, line 8Z. And but for DeFi, since you're pretty much having to guess, I would put this into the category. You can put it either on Schedule 8949. You say, let's say you think you made 100,000. You would say I had proceeds of 100,000, cost of 0. It's a one line item. It generates $100,000 of profit, and it gets taxed at your short or long-term rates as appropriate. That would be the easiest way to do that. The IRS might come back during an audit and ask for an explanation, and we can provide it at that time. But right now the forms don't lend itself. Honestly, you're making your own approximations. That's the best way to do it.
There's that scary A word. And of course, the A word, the scary one is audits. For some people, that may bring about post-traumatic stress if they have been through an audit. For others, it may give feelings of anxiety for fear of being audited. Could you demystify the audit process for our audience?
I'm very happy to do that. You're right. People just seize up at the idea of an audit. First of all, let's put it this way. We have a volunteer tax system. You get to report your own calculation of your taxes and pay accordingly. In order to keep people honest, we have audits by the IRS, where they're going to go through all the records and do calculations themselves, and they're going to come up with their own number. Typically, it's higher, and that's their position. Ultimately, if we disagree with that, we can try to negotiate with the auditor. They have limited room to move. If they don't move, we end up going to court. Go to tax court, which you can go to, and tax court. Most cryptocurrency audits are going to end up in tax court because we already talked about the conservative positions that the IRS is going to take on virtually everything. And so you're going to end up with wildly high numbers. So we all end up at tax court. At tax court, you got to understand an auditor is measured on his monthly quota attainment of how much revenue he brings in. All right. So he's incented to come up with a big number, right? He's not an impartial person. So a lot of people are going to say, oh, let's be conservative because we don't want you to get audited. Well, I mean, audit's just a normal fact of life. You want to be honest in reporting your income, so that when your taxes are paid, that you can say you did an honest job. We can argue over the details, but that happens all the time. But just because it disagrees with the IRS doesn't mean they're right, as I already explained. How do they decide who they're going to audit? They use basically data mining these days. They have a compliance campaign focused specifically on cryptocurrency. They data mine. What do they data mine? They look at your 1099 forms from crypto exchanges. They're also, and I should say this, a lot of crypto exchanges are inconsistent about putting a 1099 out to the IRS. What the IRS has done, and they did it this year, is that they have filed summonses, legal actions against other exchanges, and just simply demanded all their records. Now, let me tell you about something. I have a client who in the audit, we gave all the transaction history to the auditor, all the exchanges that he traded with in the year 2018. And then we got an information request, a document request from the auditor. It said, please provide us with all your Bittrex transaction records. And we're like, Bittrex? This client said, I never used Bittrex. And we never mentioned Bittrex, but the IRS knew about it. How would they know about it? They had run some background check and found that he hadn't reported it. Well, he did exactly what you and I have done. He created an account, did the KYC, and by the time that all got done, he was using some other exchange. He never, ever executed a trade on Bittrex. There was never a coin, never a dollar, but yet the IRS knew about this. So everybody should just embrace the fact, forget about the 1099s. The IRS is going to have the information from every US-based crypto exchange or exchange that's registered in the US. There's about 20 of them. So they data mine, they look for people. Did you report capital gains was so much. Is that in line with what we saw here on the tax return? And if they can smell somebody who didn't report it, then they're going to line them up. And it's a methodical process. So that's how they decide who they're going to audit. What happens when you get an audit? There's two types of audits. One is computer driven, which you're going to get a letter saying, hey, you didn't report all this income at Coinbase. We decided that you still owe us $30,000. Please pay. If you think we're incorrect, send us some information. So that's called a computer-driven audit. It comes with a letter called a CP 2000 letter, if people have heard of that. And it's complicated to respond to those, but we do that all the time. And the second type of audit is a human audit, where you're going to get a letter from some guy in the IRS who's going to become your worst nightmare. And he will send you a letter, and then he will follow up with a phone call and want to talk to you. First piece of advice: never talk to the auditor. Everybody's watched the TV shows. As soon as the cops arrest you, they read you the Miranda rights. You have the right to remain quiet. Then they drag them off to the interrogation room, and then their mouth starts to flap before their lawyer shows up. And IRS auditors are trained, just like policemen, on how to go right after the key issues in the first few questions. They all come off as like, well, hey, I'm Jimmy, and I'm just here, auditor. It's just going to be a simple check of your income, and they're like your friend, but they're not. I mean, that's their outside. I mean, these are all nice guys, and I've talked to a lot of them. They're all very nice, but it is an adversarial situation, and you have to embrace that. And you can have representation. You can be represented by a lawyer, a CPA, or an enrolled agent. In my case, I also have a law degree, so I bring a legal expertise. I think this video already has kind of shown what it means to bring a legal expertise into the issues of dealing with an auditor. Once an audit begins, it usually takes about 2 years to go through. Audits can be expensive. A lot of the expense is right up front, but generally $6,000 to $8,000 a year is the cost for an audit. Not to mention if you have to pay taxes after that. So it can be expensive. We offer a affordable service on cryptotaxaudit.com. It's called a membership service called Audit Defense. It's like car insurance for your tax return. You pay $195 a month, and we will defend you at no additional charge if any of your tax returns get audited for their crypto reporting. So that really pays for itself, especially for our clients of all sizes who would like that. And the biggest thing you get is the guarantee of knowing that we're going to be the ones, I'm going to be the one defending you in an audit, which, just because people call us up and want us to defend them in audit doesn't mean that we're going to do it. We're saving our capacity for our audit defense clients primarily. So let's say you go through an audit and the auditor decides that I have one client, they decided he owed $50,000. They then hit him with an accuracy penalty, and then they hit him with interest. And when it was all done, they had the thing up to around $90,000 that they wanted from him. All right, so that's kind of what happens in an audit. You get 30 days to challenge their calculation. Then it becomes permanent. And then you get 90 days to either appeal to tax court, or it becomes a formal judgment against you and you owe at that 90 days. And they'll expect payment at that time. So that's kind of what an audit is about. It just because you get audited doesn't mean you can't win. I had one client failed to report a Coinbase 1099 for 2018, where Coinbase said he made $4 million. We went in, and he had not reported his cryptos. We went in and calculated the cryptos for him, and it turned out for 2018, as crypto winter, he actually had a net loss of 17,000. So just because you go into an audit and they think they've got a strong hand doesn't mean we can't confound them, tie them up in the details, force them to make rash errors under which we can later win on appeal or going to tax court. So that's why when that's why you want to make sure that when you're dealing with an audit, you get somebody who's an expert at cryptos, expert at audits, because only 2% of all CPAs have ever done an audit. So I hope that nobody gets audited, but I think crypto people have a very high likelihood of audit, because the government accounting office has proven that where income occurs and there's no 1099 or W-2, the compliance rate is down in the 20% range in terms of people paying their honest share of the taxes. The IRS knows this, and As soon as the IRS gets their funding from government, because this Build Back Better plan or whatever's going to happen, as soon as they get their money, the audits are going to start to drop like leaves off a tree in the autumn.
That is scary stuff. I just thought of a tagline as you were speaking there, Clinton. I've just finished the Netflix series Breaking Bad. So for any fans out there, they'll know Better Call Saul. I'm thinking Better Call Clinton. Better Call Clinton. Clinton, I think that about wraps it up. I mean, wow, we've really covered some ground here. 30 minutes we had planned. We're just coming on about an hour. So we do have some good questions coming in if you want to answer a couple.
Let's blast right through them. Let's do that.
Yeah. Let's see. Okay. So we've got a couple. The question that came in earlier. Which tax forms should be used to report ordinary income for the following? Staking airdrops, masternode income, interest and lending income.
Okay, so water and staking, airdrops, these are interest, lending income. These are all forms of reward, and rewards get totaled up and added as one number on Schedule 1, line 8Z as in zebra.
Perfect. Thank you for that.
And then, so that's the masternode income. All those forms of income reported there. Crypto gains are over on Form 8949.
8949. Perfect. Okay. We got a question. I know the XRP community is strong. The songbird airdrop was distributed to exchanges on a certain day. What token price should be used for tax purposes?
This gets to that question that we were talking before. Is it taxed on receipt or is it taxed upon sale? And there are some other considerations with the songbird token, but you have that choice. Of course, if you go with taxed on sale, and if the IRS audits you, they're going to disagree with you and come up with their number, but that just means we have to push it forward to tax court. So if you want to take the conservative opinion, it would be taxed upon receipt. Now, some people say, hey, I got it and it was put over on Binance, and Binance is giving me a hard time getting those coins moved to where I can have them. In that case, it would not satisfy the constructive receipt rule because it's not trivial to obtain those coins. So in that situation, it'd be when you ultimately receive your songbird that you would be treated as income at that date. Now, the songbird, when they're initially released, had never been sold before, so we cannot really say what the price was. So on the date of distribution, what's the fair market value is $0. Now, of course, as soon as it's distributed, people would start to sell it. It'd be some sort of street value on it at that, but that was after it was received. The other issue on songbird is that this is a gift from a foreign corporation. And if you have income in excess of $16,000 from a foreign corporation, you need to file a Form 3520 to disclose it. It's an anti-money laundering form. Failure to file that, the IRS discovers it, is a 25% penalty on the income you didn't report. And we have that all explained on a course on our crypto tax audit website in the return preparation side.
Okay, perfect. Here's a good question that's come in, Clinton. This is from David. How should one address funds that have missing data in accounting or other software, so the cost basis is unknown?
Yes, so this is very common, especially in the DeFi space. New coins, a lot of these services have to get their pricing from a price oracle, if you will, CoinMarketCap, CoinGecko, and new coins simply aren't on those. A lot of new coins do not have enough of a trading history to establish that. So you're on your own. So what you have to do under the accounting rules is you have to go find a pricing source, something that lists what the price of that coin was on that day. And then you can use that price for that coin on that day. You typically can manually enter these, on all the software products. So you would have to enter that price both the purchase and sale prices in those software products. You have to make up for what they can't do.
Okay. Here's a good question, and one that we come across, I think, regularly, Clinton. So how do crypto taxes work? If you gift someone some digital tokens and they later sell for a profit, how are the gains taxed for the person gifting and receiving the assets?
So when you buy a cryptocurrency, you establish the purchase date and the purchase price. Now, when you gift it, you are neither selling it nor exchanging it. So it's not a capital gains event for you. So let's say I buy some crypto, it's worth 2,000. And then when it's at 5,000, I now give it to another person. When I give it to them, there's no tax to me. To them, they're receiving it. They receive, as a part of that gift, the original purchase date and purchase price. So the asset they have is worth 5,000, but if they were to sell it right away, they are going to have to pay tax on the $3,000 gain. All right. So they're going to pay tax on the gain that you actually held it for. But, that's a gift, so they shouldn't cry. So that's that aspect. So they pay the capital gains tax. For the individual who's giving, you're allowed to give up to $15,000 a year to any person. And if you're a married couple, each can give $15,000. If you give over $15,000, then you have to file a gift tax return. And a gift tax return is let me rephrase this. I won't get into the detail on it, but just say it's over $15,000, you need to file a gift tax return. Typically, there's no tax associated with it, but it's a significant form to file. And if you don't file it when you're supposed to, you get hit with a 40% tax on the unreported amount, I believe.
Okay. Great explanation again, Clinton. It's really detailed. You okay for one or two more questions? How's your schedule?
I'm doing great.
Yeah, you're pumped.
I got the energy. My coffee's coming soon.
Oh, great. Okay. Let's see. We've got a question here. If you reported staking rewards last year and decide to not report staking rewards this year, will that be a red flag to the IRS?
No, because think about it. Staking rewards, the mere giving of the receipt of the rewards, how does that reported on a tax return? It shows up on Schedule 1, Line 8Z, where you list the total amount of income that it falls into what's called other income. So in that case, it's just a number, all right? And the next year, you don't have a number there. I mean, there's no other indication the IRS has. They have no knowledge that you receive staking income, unless it was staking on a US-based exchange, where they're going to report that income as a part of miscellaneous income. That would be the only case. But like if you just did private, you got like Cardano and you're verifying it with some private wallets and stuff. Yeah, that's not going to show up as income. So it's not a red flag. I do believe everybody should report all their income and pay taxes on it, but this would not be a trigger.
Okay. Great. Let's just have a look. Question comes in. What happens if you get paid with crypto under $250 for contract work? So that's wages.
You have to report it.
Yeah.
There is
no getting away from that one.
In some countries, if you have a capital gains event that's less than $200, then you don't have to report it. For crypto traders, that might be like almost all of them. So for some traders, but that is not a U.S. tax option. You have to report every trade. Even if you don't have to report everyone. So what happens if I get paid? So this is basically going to be reported on Schedule 1. Well, typically, if this is for labor, you would report it on Schedule C as work income. But either way, it's taxed at your marginal tax rates.
This is a good one because you have somebody in jail.
All right. I'm being pointed to someone here. Which one? Ken's? Alana?
No.
We got a question here from Mad Worship. How does having a nonprofit foundation help crypto tax? So I have a client who represented, he had a lot of Bitcoin and he took it as income and claimed that he was a pastor of a church, a nonprofit, and therefore didn't have to pay tax on the Bitcoin. He did this in the years 2015 and 16. He's been in jail now since September 1st because the IRS considered that fraud and they prosecuted him and threw him in jail. So I don't think that's the gist of this question, but I want to put that out there. In this case, nonprofits are not subject to capital gains tax. Okay. If the income is derived from business activities that are not related to why they were created, it could be subject to what's called unrelated business income tax, UBIT, and would be subject to a certain amount of tax. But most nonprofit activity income is derived from the things they do as a nonprofit. So that's how nonprofits would be taxed. Or actually, there's no tax.
Good question. Let's see if we can sift through these, if there's any more to jump out. Someone asked about, can you speak to self-directed IRAs where the trustee is assigned, but IRA holder has crypto on a separate cold storage?
So self-directed IRAs represent an interesting vehicle for investing in cryptocurrencies. There are an inordinate number of types of IRAs and rules and regulations around them. One key regulation about IRAs, individual retirement accounts, is that there are people who are disqualified from interacting with the IRA. This would typically be you, the beneficiary, your spouse, your children, or parents. They cannot have any dealings directly with the IRA. Otherwise, it'd be considered a distribution and taxed. So now, that being the case, there's lots of different ways to set up a self-directed IRA. Typically, the IRA will have a trustee, but then you can create a LLC, which the IRA owns, owns the ownership of the IRA or the LLC, and then the LLC could then invest in a variety of things, but it all has to be with unqualified, well, people that aren't disqualified from interacting with. So now it might be that you are the one handling, because you're going to be doing a lot of the work. You might be doing the work of the LLC, but you cannot do transactions where you benefit from them. So you could be the one holding, let's say, a ledger for the LLC, but that needs to be the LLC's ledger. It cannot be commingled at any time or in the past with your personal, ledger. It can't be. It has to be dedicated. It's probably best to avoid that complexity is to leave IRA assets on the exchange, like a Gemini or Coinbase exchange. Just leave them there, just to avoid the appearance of malfeasance.
Okay. There's a lot of good questions in here. You okay for one or two more, Clinton, or do you want to?
Fire away. Yep, I'm still good.
Yeah, you're still good. Okay, you are on fire tonight. Let's just have a little look. So I'm just sipping through.
I should say while you're looking, at Crypto Tax Audit, we're running the benchmarks on a regular basis that we showed you the results. Our commitment is to rerun these benchmarks every 3 months, and we're going to publish them. And hopefully, our hope is that more and more of these companies will start to put out their version, their Gen 2 version of their product, and we'll start to see increased accuracy. And we hope that we can see that. And at some point in the future, we can be able to say, hey, these guys and those guys are starting to do some accurate results. And we want to benchmark it because we all want to have confidence in our DeFi results, and we anxious to see that. So just check out our webpage at cryptotaxaudit.com/DeFi, and our tax benchmark is there, as well as the other articles that we've written about it.
Okay. Here's an interesting one, Clinton. I think I've seen 2 or 3 people mention this. Matthew says he thinks it's ridiculous that the IRS expects us to pay capital gains in US dollars when our gains are not in US dollars, but rather in crypto. The IRS needs to accept crypto to pay taxes.
Well, it's an international accounting standard, and just as true in US. It comes from the GAAP regulations, I think section 42, where cryptocurrencies have to be reported, not cryptocurrencies, assets have to be reported in the functional currency. So in the US, the functional currency is the US dollar. So we can look on CoinMarketCap and other places. We can see what the prices are of your cryptos. You don't like that, get over it. That's the law. You might as well go kick a concrete wall on that one. So, the IRS needs to accept crypto for payment. That's a separate issue. It has to deal with legal tender. And from what I understand, this is a very hot issue in the executive branch of the government, and they're working it out. But for now, that's not happening.
Yeah, that's just the way it is.
Get over it.
Yeah. Just see.
2 more questions.
2 more questions. Okay, and then we'll wrap it up. Yeah, because we're well over the hour mark. Let's see. Gary has asked, do you have capacity for new customers for 2021 tax returns? How are we looking?
Yes, I do. I have another IRS auditor calling me up right now, so we're going to put him in the voicemail. Yes, we do. We have capacity to take on some new clients. If you go to our website at cryptotaxaudit.com, under our products, you pull down the page that says tax return preparation. We offer a whole set of do-it-yourself tools that are very affordable and give you powerful solutions. We also offer full-service tax return preparation, which would include gain, CFI and DeFi gain calculation, as we described. And we have videos that explain what we're doing. We also have our pricing laid out there. It's very simple pricing. We do charge a higher amount for first-year tax return preparation. And the reason being is we're focused really on serving large traders who are looking for a multi-year relationship in tax preparation. So we do that by charging a higher amount initially. So we certainly, if that is beyond your budget, we have the self-help tools there that I think you'll find are amazing.
So best advice, visit cryptotaxaudit.com, schedule a call with yourself maybe, or have a look through the different options there.
Yeah. After you've looked at the prices and you want to go forward, schedule a call. We'll talk about your situation and get you started.
Okay. Perfect. I'm just trying to pick something else. We'll go for one more question, Clinton. Yeah. Sorry, Clinton, I'm just trying to sift through. We'll get one more. Right. Motion. So that's a similar question. A lot of similar questions here. Oh, that's from the same person, not to worry. How to avoid double taxation. If I buy one Bitcoin at 10,000 and trade it for Ethereum, and then later trade it back for Bitcoin for a gain, I have to pay the gains in USD, but I don't have the gains in USD. So
it would be helpful to think of it this way. If you have done any work on a brokerage and bought stocks or mutual funds on a brokerage, you have cash in your account, you spend the cash to buy Google stock, and now I want to own Microsoft stock. So it's a two-step process. I sell the Google stock. Once it clears, I now have cash in my account, and then I can buy the Microsoft stock. So I think that's helpful. See that everything goes back to cash. With a crypto exchange, we can collapse that process and actually map Google sellers with Microsoft buyers and create a trade. Now, if that just doesn't happen in the stock world. It has never been designed that way. People typically want to go in and out on cash, on stocks, but with crypto, you're basically conflating those two actions into one action, an exchange for Bitcoin for Ethereum. So the fact that it never goes to cash does not in any way change that you effectively reinvested. So you sold and then you reinvested. You did a two-step process when I do that trade for Bitcoin to Ethereum. And just because it never actually touches cash doesn't mean you didn't experience a gain. The way the tax law is written, it says when you sell the asset, you enjoy a gain or loss, which is true. And the evidence is that you're able to buy more Ethereum than you would have earlier. So and then everything, again, according to GAAP rules, comes back down to express it in the functional currency, U.S. dollars, and so yes, there's a gain. And again, that it's not in U.S. dollars. The sun won't rise tomorrow either. So you can deny that as well, but it will.
Perfect. Well,
so hey, that's been a lot of fun.
Yeah, that brings us to the end. And maybe for some people who got into the discussion a little late, where's the best place to find you, Clinton?
Cryptotaxaudit.com is where we're at. If you need help with an audit, tax return preparation, we have our DeFi tax benchmark, which might be a solution for people, as well as self prep things, and a lot of people schedule consultations with me. We have a half-hour consultation, and we get right to the issue. You see how direct I am. I know the law. I know I'm good, and you're going to get your money's worth when you call me up. I was talking to a lawyer last week. He goes, I got more in this half hour than I ever could have dreamt, and he paid for the time. So, you will get a good value, and you're going to get expertise, and you'll talk to me. But love to try out our audit defense service. Really is the biggest price performer of the whole lot. If you're someone who wanted us to do your tax return, you probably have a multi-year issue, of which last year was a big year. And we can prepare the tax return, but a lot of people find that maybe if I do the self-help tools, use that with my current accountant or do it myself, TurboTax, along with the audit defense membership, it gives them the biggest bang for their buck. Remember, audit defense, it's car insurance for your tax returns.
Fantastic. And just to mention as well to the audience, you do have a Twitter account at CryptoTaxFixer. That's where you'll find Clinton Donnelly, and he posts regularly there. Very good content. So definitely advise you to follow at CryptoTaxFixer. Thank you very much, Clinton. It's been an absolute pleasure speaking with you this evening.
It's been a pleasure. Thank you so much, Liam.
All the best. Talk shortly.